Our next guest sees positive signs into year-end and for 2022. Joining us right now is Noah Blackstein, who is Senior Portfolio Manager at Dynamic Funds. And Noah, all this doom and gloom, all this concern about inflation, what it means, the market keeps powering higher. You think that's going to continue. Why?
Well, I think that there's a number of things going on. Obviously, financial conditions remain fairly easy. I think that earnings have remained strong despite higher input costs. This is the first recession that we've ever been through where you've seen strengthening of the consumer balance sheet as opposed to weakening of the consumer balance sheet. And corporations continue to be fairly strong in terms of both balance sheets and buybacks coming up. So I think we're in a fairly a positive environment that looks to continue into early 2022. Not to say that there aren't risks, obviously that there are risks. But I think that from our perspective, that for now anyway, that the positives outweigh some of those risks that are a little further out.
You know, David Kostin at Goldman Sachs is out this morning raising his profit outlook for and his target, his price target for the S&P 500 to up about 9% for the end of next year. I think he has it at 5,100 by the end of next year. He said something really interesting, just that he expects the margins, profit margins, to increase another 40 basis points by the end of next year. And that's kind of phenomenal when you consider these higher costs. Do you agree with that? And why do you think that's able to happen?
You know, I think when you're looking out to 2022 and where the S&P 500 is trading, you know, you probably have somewhere around $210, $220 of earnings for the markets next year. You know, I think that the important part when you're forecasting that type of return, 9-10% return next year, really is for those earnings to come through. And I think that we've reached a point where we have sort of we're embarking on a tightening cycle for sure. We have obviously the withdrawal of stimulus, which is a fiscal drag. So I think the market can do that. But for investors, I think it's really important to focus on companies that can deliver on those earnings because we're not starting from a point of extremely low valuations here. And so do I think that the market could be up 10% next year? Yes, it's going to be a lot more tricky than it was this year for sure, given a few of the headwinds. But the focus really needs to be on being able to deliver on earnings and exceed those earnings for the companies that you're involved with next year. So can it be done? Yes. The driver of that, though, is going to be the underlying earnings. I think input costs are high. I think labor costs are going to remain high, which I don't view as a negative. I view as a positive. I mean, I think if you believe in free markets and then a good market for labor is positive overall. That will get companies to automate more, perhaps, and pay up for labor. But I do think a lot of the input price costs, which are supply chain driven, will ease as we start to move through 2022. My only concern is that there's a Fed reaction to temporary inflation that the bond market isn't pricing in, and that we get a bigger decline than we expect.